Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Yeah, let's go.
We are diving into CoreWeave. They've really positioned themselves as the pure play AI GPU cloud provider, a hyperscaler just for AI.
And the core idea here, the thesis, is that it's trading at a big discount right now.
A material discount. It follows a recent sell-off that was, driven by supply chain news, not a fundamental problem.
So it could be a really interesting, maybe asymmetric entry point into that whole AI infrastructure layer.
Exactly.
Okay, so that's a powerful story. But what kind of numbers are we talking about here? When you say hypergrowth, what does that actually look like?
The numbers are, well, they're pretty exceptional. If we look at Q3 of 2025, the company delivered $1.365 billion in quarterly revenue.
Just in one quarter.
Just in one quarter. And that marks 134% year-over-year growth.
Wow.
And management's guidance for the full year, they're looking at 5.05 to 5.15 billion.
Which implies what kind of growth for the full year?
A staggering 174% year over year. And what's really interesting is that they actually raised that guidance by $250 million.
They raised it, even with supply problems.
Even while assuming some of those near-term supply headwinds, it just shows you how strong the underlying demand is.
Okay, growth is one thing. We see a lot of tech companies grow fast. But how are the margins? Is this hypergrowth just, burning cash to get revenue?
And that's where it gets really interesting, because you'd expect that, right?
Absolutely.
But in Q3, their adjusted EBITDA, it surged to $838 million.
Okay, and as a margin?
That's a robust 61% margin.
61, that's a mature company margin.
It is. For 2025, the projection is for around $3.06 billion in adjusted EBITDA. So you're looking at a margin profile that's comparable to, say, a mature hyperscaler.
But at a much, much faster growth rate.
At 10 to 15 times the revenue growth rate. Yeah.
So why are they achieving this kind of dominance? I mean, why aren't the mega caps, the AWS or Azure of the world, just crushing them? They already own cloud infrastructure.
This is CoreWeave's primary moat.
Right.
It's a structural issue in the market.
Okay.
There's a massive funding gap for AI infrastructure, somewhere between $500 and $800 billion annually, globally.
And we always hear the bottleneck is GPUs, that NVIDIA can't make them fast enough.
Right, but that's not actually the real constraint. NVIDIA is producing enough H100s, enough H200s. The true bottleneck, it's powered data centers.
You mean the physical buildings and the electricity?
Exactly. Getting the power grid interconnected, that can take up to 7 years for approval in some places. It's a massive delay.
So CoreWeave is one of the few that figured out how to get the financing, the buildings, and the power hookups all at scale.
They're selling the critical real estate in an environment where demand is just. It's completely outstripping supply.
And that gives them incredible pricing power.
It does. It shows up in their unit economics. They generate $2.58 million in revenue per megawatt per quarter. That reflects their pricing power and their GPU-first architecture that's, purpose-built for AI.
That pricing power only works if you have reliable customers, though. Do they? Who's signing up for this?
Absolutely. They have a massive revenue backlog, $55.6 billion.
$55 billion. That gives you years of visibility.
Years of visibility. And critically, 60% of that backlog is with investment-grade customers. We're talking major banks, huge tech giants.
Who are the big names we should know about?
Well, their largest relationship is a $22.4 billion total deal with OpenAI.
Okay, so the leader in the space.
And a $14.2 billion amendment with Meta. These aren't just small contracts, they're huge commitments from the heaviest hitters in the industry.
And they're expanding beyond just those two, I assume.
For sure. They've secured new wins with places like Mizuho Bank and even NASA's Jet Propulsion Laboratory.
Interesting.
So the demand is broadening out.
All right, let's talk about the elephant in the room. The balance sheet shows $18.8 billion in total debt. That's a number that makes a lot of investors nervous. How stable is that?
It is a big number, but it reflects a very deliberate strategy. They finance all this growth through what are called take-or-pay contracts.
So they use those stable customer contracts as a collateral.
Exactly. It minimizes equity dilution. They're not giving away the company to fund the growth.
And the debt itself, is it manageable?
Well, what's fascinating here is that they've been successfully refinancing that debt at much lower costs recently.
Which shows their creditworthiness is improving in the eyes of the market.
Dramatically. For example, some new facilities were priced at SOFR plus 425 basis points.
And for people who don't follow this, what does that mean?
It means they got a deal that's about 900 basis points or 9 full percentage points cheaper than some of their older non-investment grade debt. That's a massive vote of confidence.
But still, that much debt means heavy interest payments. And I saw that free cash flow is negative, right?
It is negative, but that's strategic. They're investing heavily ahead of the revenue that's already been contracted. It's a standard pattern for a business like this that's growing so fast.
They're spending $12 to $14 billion a year on CapEx.
Right. But their projected $3.1 billion in annual EBITDA, that provides more than enough coverage for their roughly $1.2 billion in annual interest expense. The debt is serviceable, and it's getting easier to service.
Okay, so if everything is so strong, the growth, the margins, the moat, the customers, even the debt story, why on earth did the stock fall 32% recently? That's the big question for anyone looking to invest now.
Right. And the sell-off was driven by a forward guidance reduction, but not on revenue. It was on capital expenditure.
They lowered their spending plans.
They did. From around 23 billion down to 14 billion. And this was not because of an operational failure on their part.
It was the supply chain issue we talked about.
It was reliance on third-party data center developers and delays in getting what are called powered shells, the physical buildings.
So the market panicked over a timing risk, not a demand risk.
Exactly. The demand is still there. The contracts are signed. It's just some of that revenue got pushed out into Q1 2026.
The market reacted to supply noise instead of a fundamental weakness. That makes sense. So what are the real risks then going forward?
I'd say there are two main ones. First is still supply chain execution. If those powered shell bottlenecks get worse and revenue slips even further, that could become a problem.
But they're working on that, you said.
They are. They're mitigating it by diversifying suppliers and, importantly, investing in their own self-build capacity, like the sites in New Jersey and Pennsylvania. They're trying to control their own destiny.
Okay, and the second risk?
It's still the debt risk. They have to continue to manage and refinance that $18.8 billion.
But again, the mitigation there is the quality of the customers backing that debt.
Precisely. It's secured by high-quality investment-grade contracts, and they're proving they can refinance on better and better terms.
So if the fundamentals are strong and the risks seem manageable, how does the valuation look right now after that sell-off?
It looks compelling. That's why we're talking about it. It's trading at about 8.4 times 2025 estimated revenue.
For a business growing at 174%.
Exactly. That multiple is considered, materially cheap relative to that growth rate. It suggests a really asymmetric upside once these supply concerns normalize.
And where do analysts see it going?
Most of the price targets are well into the $140 to $150 range as a base case once these timing issues are resolved.
It really sounds like CoreWeave presents a rare opportunity then. You have the hypergrowth, strong margins, incredible revenue visibility, but with a temporary supply problem baked into the price right now.
It is. The question for investors is simply whether they have the patience for that supply to get resolved.
The key takeaway seems to be that this company is a structural winner from a multi-year AI power shortage. And the recent noise is just about timing, not about conviction.
I think that's a perfect summary. If you're looking for long-term exposure to the AI infrastructure backbone, this presents a very compelling case.
We'll definitely be keeping a close eye on their Q4 earnings, which should be out late January 2026, for any updates on those capacity delays. Thank you for joining us for this analysis. If you liked what you heard, please make sure you subscribe to Smart Wealth with Joshua for daily stock analysis and Catalyst Talk.